What makes you feel that holding cash is going to help you in the hour of need? If you also follow one of those financial advisors from Wall Street with his mantra of 60% stocks and 30% bonds, then you might want to hear what Warren Buffett has to say about this mantra. Every dollar you invest in stocks is just another worker for you, laboring day and night to get some more workers inducted into your team. But the majority of investors don't put their money to work for them, and this is exactly where they miss out. In this video, we're going to talk about the 10 major mistakes that investors make and end up losing millions of dollars. Welcome to 5-Star Finance, the place where we provide you with all the tools and rules and teach you how to achieve financial freedom. Now, there's one thing which is quite strange, to be honest. Value investors starting with the same resources and the same number of principal capital to invest in stocks end up at different positions. Some manage to get great returns and change their life forever, while others end up losing all their money and are at risk of going broke. Why is that? According to Warren Buffett, there are 10 mistakes every investor needs to avoid at all costs. First up, a lot of investors hesitate to put their money to work and instead hold on to cash. That is exactly the situation where you don't want to find yourself in. Warren Buffett says you'll find us quite unhappy over time if cash keeps building up. Similarly, he also puts it, we want all our money working in decent businesses. Now, there's a lot to these words by Buffett. When we hold on to cash, we're more likely to lose that money with growing inflation. Moreover, when we don't put our money to work, there's always a risk of missing out on an opportunity. There are countless investors out there who played it safe and they missed out on some gigantic profits. The second mistake that most value investors make is watching the market too closely. To put it simply, many investors don't go for the buy simply because that financial advisor on TV thinks that the bear market is going to go the extra mile this time around. According to Buffett, we just don't know about the market, and to give up something that you do know and that is profitable for something you don't know and won't know just doesn't make any sense. Many investors are put off by the market, and according to Buffett, we can't control the market. But what we can control is the choice of where we are willing to put our money. Which business we want to invest our money in should not be affected by what the market might look like tomorrow. Most investors make the mistake of predicting the market and its cycles, but deep down, no one really knows what it's going to do, and will be lying to you if they say they know what the market is going to do. According to Buffett, the third mistake investors tend to make is that they rely too much on diversification. He says diversification as a practice generally makes very little sense for anyone who knows what they're doing. Diversification is a practice against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. Diversification is for someone who does not know how to analyze business and value businesses. It's absolutely crazy to own 50 stocks, 40 stocks, or even 30 stocks because there aren't many wonderful businesses that are understandable to a single human being in all likelihood. The fourth mistake every investor makes is that they don't understand risk. Now, as far as Warren Buffett is concerned, risk has nothing to do with volatility. Risk is simply the probability of losing the initial investment. For many people, the risk is something else, but for Buffett, he simply won't invest in a business where his principal sum is not safe. Risk is not measured by external factors or macroeconomic situations, but it is always related to your initial sum of investment. At number 5, many people think that it is the high IQ which makes a successful investor. But according to Buffett, as long as you have a stable personality, you're good to go. As he says, it's the temperamental quality and not the intellectual quality. You don't need to have tons of IQ to make those investment decisions. You don't need to play three-dimensional chess if you're good at playing those basic moves. You need a temperament that neither drives great pleasure from being with the crowd nor against the crowd. It is not a business where you take pills, it is a business where you think. The rule is simple. You're not right or wrong if 1,000 people agree with you. And similarly, you're not right or wrong if 1,000 people disagree with you. You're right because your facts and reasonings are right. The sixth common mistake most of investors tend to make is they don't invest in themselves. As Buffett puts it, when you invest in yourself, no one can take it from you. Many investors simply don't invest in making themselves better or striving to improve every day. According to Buffett, if you can simply learn to communicate better, you're increasing your value by 50%. But if you don't know how to convey your ideas, you're creating problems for yourself, and many investors simply ignore this aspect and create problems for themselves. The seventh mistake many investors make is that they believe in 60-30 or 65-35. According to Buffett, most investors play it the wrong way when it comes to asset allocation. Many people believe in investing some of their money in stocks and putting the remainder in bonds and other assets. According to Buffett, they're just minimizing their chances of making some profit. You don't swing until you get that right pitch, but once you get that pitch you're looking for, you throw the absolute kitchen sink at it. Next up, we have trading day. Many people rely on day trading to make some quick profit, but they ignore the long-term profits that they could have made by letting their money grow. According to Buffett, day trading comes very close to gambling as defined. It is human nature. People like to gamble and put their money at risk. For example, if you're sitting watching a boring football game, you're probably going to like it much more when you bet a couple of bucks on it. People simply ignore the power of compound interest in the long run, and that's where the problem begins. The ninth mistake many investors make is that they follow the trends. According to Warren Buffett, people tend to move with the flow, and they don't give analyzing businesses a chance. They're happy to execute what that financial advisor on TV asked them to do, or that neighbor who made 50 bucks by day trading. Just like the dot-com boom, which at its peak attracted many investments and it became a trend to invest in those tech stocks, but it was devastating as the crash took away everything. The 10th mistake investors make is that they wait for corrections. Many people simply wait for the market to gain momentum, whereas according to Buffett, when the market is down, that is the time when you buy some undervalued stocks. After all, when you get some stocks below their intrinsic value, you're very likely to make some serious profits from it. Most people simply wait too long for the correction and end up losing the chance to make millions or even billions. This is the reason that every value investor needs to learn how to analyze stocks. Analyzing stocks is the first of many steps towards financial freedom, and these stock categories will provide you with a decisive advantage over other investors in the stock market. This is the reason we provided you guys with a free ebook in the comments section below, which will explain the 6 stock categories in detail. And the fun thing is that every stock category brings something different, and they're all different to analyze. Check out the video we handpicked for you, and we'll see you in the next one.